Hey, welcome back to this week's episode of Closed by Mo. My name is Mohammed. I am hopefully your favorite YouTube host on most things real estate. I'm also a real estate investor and a realtor. Now, this week's episode is very special because it's the start of a new series I'm going to be calling Market Moments as a way for me to talk a little bit more about what's going on over in the overall economy, but with a little bit more focus in real estate, not crypto, not stocks, or just real estate. Now, before I jump in, there's two things I want to share with you guys. Number one, if you don't really like these videos or you think like, hey, this video is way too long, I'm going to put the link for the blog post for this video in the description below. Yes, I have a blog. Yes, most of my videos and blog posts sort of crisscross. So it's still great content if you're on the go and you just want to read it or maybe send it to someone. And number two, one of the more important things to keep in mind, nobody knows what the market's going to do tomorrow, in a month, in a year. People have predictions. They can, hypothesize based off of what they think they know, based off of what the information's already available. But no one really knows 100% what the market's going to do. So whenever I consume content like this, I always like to be sort of cautiously optimistic and take things with a grain of salt because there's a lot of different factors that can come into play when it comes to the overall economic health of a country or of the world. Things like protests in China, rising interest rates, commodity prices like oil changing, fluctuating. There are a lot of different factors that go into this, so please don't take one piece of content and assume that that's the end all be all. Now, without further ado, let's jump right into the first episode of Market Moments. Now, the most important event that people are sort of on the edge of their seats for, waiting to see what will happen, is the Federal Open Market Chair Committee meeting on December 14th. After this meeting, they're going to announce whether or not they'll be raising rates by 75 basis points or 50 basis points or somewhere in the middle maybe, or somewhere less or higher. 75 basis points is 0.75% and 50 basis points is 0.50%. Now, I have my own opinion about which direction the Federal Reserve is going to be picking. But before I jump into that, I want to give a very quick overview on why the Federal Reserve matters a lot here. So the Federal Reserve, or the Fed, has two core responsibilities, which is stable prices and low unemployment. Unemployment has been at its lowest in US history since the last 50 years, and price stability is very closely related to inflation, which I don't think I have to remind people about how inflation has been for the last 7-8 months, right? What you will notice, however, and I'll put the chart here too, is since the start of 2022, since the Fed started raising interest rates, and they've raised them 6 times this year, the last 4 times have been 75 basis point hikes. Since they started raising interest rates, inflation has actually steadily started coming down. So if you take a look at the chart, you'll be able to tell that we're sort of on a downward trend. Now, this is still far from where we're sort of targeting at 2%, but this is a very good sign, and it has some people hopeful that maybe we won't see a 75 basis point hike, but a 50 basis point hike, which would signal the Fed pivot that a lot of people are sort of speaking about. Myself personally, I think the rate hike will be at 75 basis points because even though inflation is coming down, unemployment is still incredibly low, and the Federal Reserve knows that in order to have any kind of serious long-term effect on inflation, they have to keep raising interest rates until demand gets destroyed, and a way to destroy demand is by affecting the labor market right now. And I hope I'm wrong. Personally, I'd love to see a 50 basis point hike because that would signal the turn of the Federal Reserve's policy, so it would be a Fed pivot, and that'll be overall really, really great for the economy and for the numbers. But realistically speaking, I think a 75 basis point hike is probably what they'll be leaning more towards. Now, what does this all mean for real estate? So let's look at the newest report from Black Knight Reporting Group, and I'll put the links for the reports all in the description so you guys can see where I'm getting my sources from. In terms of overall housing inventory, listings and overall inventory has actually dropped through October, almost 20% still below pre-pandemic levels. What they were able to calculate was that there's a 40% inventory deficit still. What that means is for every 10 home buyers in the market, there's only 6 homes to satisfy that need. So even though there's been a pullback in demand, the pullback in home inventory hasn't really helped with outpacing that pullback in demand. And what I mean by that, and what their hypothesis is getting at, is that high rate, those interest rate hikes, have actually dampened the overall inventory of homes in the market. Now, what I'm suggesting is that because of rate increases, there's been fewer buyers on the market, and because there's fewer buyers on the market, home sellers understand that maybe it's not the best time to sell. That's overall affecting the amount of home inventory in the market. So it's like a lose-lose situation with the interest rate hike, which is probably what the Federal Reserve was sort of getting at. One bit of interesting fact as well that I learned was that overall, of all the mortgages that were originated in 2022, 5% of them are now already underwater, like barely underwater, meaning that they owe more than what their homes is worth. And about 20% of them have less than 10% equity in the home, which is almost predicted because as rates rose, home prices dropped. And if you've taken out a mortgage this year and you see your home value dropping, it means you're probably either getting close to underwater or the amount of equity that you have in your home is getting eaten away. Now, what my personal prediction is, or what we'll start to see over the next, I would say 18 to 24 months, is there's going to be a rising trend of overall foreclosures across the North American market as interest rates continue to rise. Even though the Federal Reserve may signal that inflation is, sort of getting reeled in because of the downward trending inflation curve, we're still a long way to go from the target rate of 2%. So I do feel that we still have a little bit of pain left that we need to go through from the next 18 to 24 months. And then the most important aspect that I think will be an indicator for me is how the rising rates eventually will affect the labor market. As we've already started hearing of layoffs, and I think this is obviously what the Federal Reserve wants to do in terms of destroying demand. With that, guys, I really hope you enjoyed this video. Please like and subscribe. It really helps the algorithm. I appreciate you guys watching, and I'll see you guys next week. Bye-bye.